Hey, Happy New Year in advance, Doctor. We are Group AE, and our group member is that's Han Chenwenjie and Han Yunlu. And today we are presenting our research on the empirical analysis capital asset in the Chinese stock market. This data aim to evaluate the validity of CAPM in Chinese unique financial environment, providing insights into application in an emerging market. And let me briefly outline the schedule of our presentation. It's about 4 parts: introduction, proof, review of theory, and empirical research. The last part is conclusion. Let's start first part, introduction. And this slide outlines the problem and the objective of our study. The problem is that while CAPM is widely used, its applicability in emerging markets like China remains uncertain. And to address this, our study aims to employ the characteristic of return distribution, test the weak form market efficiency, and evaluate the CAPM model in the Chinese stock market. This goals guide our analysis. And where is our data from? This slide introduces the data source. And we use data from the Chinese stock market, and including monthly closing price of the SSE Composite and the CSZSE Component Index, and January 2040 to December 2024, and 1 year Treasury bond yields as risk-free rate. Time is March 2016 to December 2024. Monthly logarithmic return were calculated and time series, and the cross-sectional regions were applied to evaluate the CAPM model's validity and limitation in the Chinese stock market. And the next part is brief review of theory. And we won't go into much theory here, so we will just briefly mention those theories we applied, including 4 theories. First one is efficient market hypothesis. Second is random walk theories and market efficiency. Third is capital asset price model. Last one is test of market efficiency. Okay, next please welcome Chenwenjie to introduce next part.
My name is Chenwenjie. Let's begin with the Chapter 3 Empirical Research. This section focuses on the empirical application of the CAPM model in China's stock market. By analyzing 11 years of data, we aim to evaluate market efficiency and provide practical guidance for investors. Using tools like the descriptive analysis, autocorrelation test, and the unit root tests. Our empirical research is divided into 3 main areas. 1. Analyzing the distribution characteristics of stock market returns. 2. Testing the efficient market hypothesis. 3. Conducting empirical tests of the CAPM model. We examine the daily, weekly, and monthly returns. Returns use slight negative skewness and high kurtosis, indicating non-normality. The Yardbarrow test statistically confirmed this deviation. This finding highlights the non-normal behavior of stock returns. The table summarizes the statistical properties of returns. Daily returns have the lowest mean and the volatility. Monthly returns exhibit higher standard deviation but reduced skewness and kurtosis. This progression reflects the different characteristics across time interval. Here are the COCO plots for SSE and SASE indices. Most plots shows deviation from the normal line, particularly at the tails. The further confirms the non-normal distribution of stock returns in the Chinese market. To test the market efficiency, we applied one autocorrelation test, which showed the varying levels of market efficiency across the years. 2. Unit root test confirming stationary of returns, supporting efficiency under certain conditions. The table shows autocorrelation coefficients for different years. Some years indicate weak form efficiency, while others deviate significantly. This highlights fluctuation in marketing efficiency over time. The unit row test confirms that most returns are stationary. The ADF test statistic is significant. Reject the null hypothesis of the non-stationary. This aligns with the marketing efficiency hypothesis under specific conditions.
Let's move on to empirical tests of the CAPM. It includes 4 parts. Sample selection. The data selected are from the China stock market trading database, which has monthly closing price data of 39 stocks of the SSE index from March 2016 to December 2024. And the return formula is in the form of logarithmic difference, where RT denotes the yield, PT denotes the stock closing price at moment T, and PT minus 1 denotes the stock closing price at moment T minus 1. The risk-free rate is selected as the monthly data of China's one-year Treasury bond yield from March 2016 to December 2024. This paper uses the BGS method for time series regression and the Farmer-McBeth method for cross-sectional regression, assuming the APM conditions where unsystematic risk is fully diversified. The observation period is divided into 3 phases. 1. Formation period. 2. Initial period. 3. Text period. Now let's talk about empirical testing. Firstly, the excess return of each stock at each time point of the portfolio formation period and the excess return of the market index are calculated for 39 time series regressions, and then the obtained beta values are grouped in order of magnitude, and here they are divided into 13 groups. The portfolio returns were calculated using specific formula. The results shows that all portfolios except Group 13 have significant beta values greater than 0, and a positive correlation between return and market risk. The DW values near 2 suggest no first-order correlation, and high determination coefficients point to potential overfitting. All portfolios except Group 13 pass the F-test, confirming significant linear effects, providing beta values and residue terms for the third phase of cross-sectional regression. Model 1 results show that neither alpha 0 nor alpha 1 are significant at the 5% level, with alpha 1 being negative, indicating negative correlation between return and market risk. The low F value and determination coefficient suggest other factors may influence stock returns. Model 2 results indicate that the residue term has no significant impact on stock returns and is an irrelevant factor. Model 3 and 4 show that stock returns are positively correlated with the coefficient of the measure of risk beta, indicating that expected return on an asset rises with market risk. In line with basic predictions of CAPM, the coefficient of the square of beta is negative and the t-statistic is large, suggesting that there is no linear relationship between returns and market risk. The addition of beta p to the 2 and SCP significantly improves the goodness of fit and also induces an increased efficiency of the intercept term. Empirical findings analysis. First, in the Shanghai stock market, expected return is positively correlated with systematic risk, with evidence of a potential nonlinear relationship. 2. The APM model shows partial applicability in China, reflecting a high-risk, high-return market. 3. Non-systematic risk significantly impacts returns, likely due to investors' inability to fully diversify or issues like information asymmetry and price errors. Last, the CAPM model has limited explanatory power in China's market, where imperfections, speculation, irrationality, and small sample size affect its applicability. The last chapter is conclusion. Due to the limited sample size and methodology, the CAPM model has some applicability in China's market, but shows limited explanatory power. Further studies with more data and refined methods are needed. Thank you for taking the time to join our presentation.